Hello, welcome back to this week's market update. Today is Monday, August 4th, 2025, and we'll jump right in. It was a mixed week for economic data with a stronger than expected second quarter GDP print, overshadowed by a disappointing July jobs report and sharp downward revisions to prior months. A new round of tariff rates were also announced Friday, featuring a mix of rate increases and decreases set to take place later on this week, ultimately leading the market to close lower for the week. You can see the Nasdaq Composite was down just 2.17%, followed by the S&P 500 down 2.36%, and the Dow Jones Industrial Average down the most, 2.92% last week. The July jobs report came in softer than expected, adding just 73,000 jobs in the month of July. Job growth was concentrated in healthcare and social assistance, while federal government employment continued to decline and other sectors showed little change. The unemployment rate ticked up slightly to 4.2%, in line with expectations, and we saw average hourly earnings grow 3.9% from a year ago. However, the average duration of unemployment climbed to 24.2 weeks, which is the highest level since April of 2022. One of the bigger shocks from the jobs report last week, other than the weaker than expected job growth, were the significant downward revisions to both May and June data here. May's job gains were revised from 125,000 to just 19,000, and similarly, June's figures were lowered from 147,000 to just 14,000. So, two pretty big months of downward revisions, a net downward revision of over 250,000 jobs. So, overall, reflecting a much cooler labor market, adding complexity to the broader economic outlook. Also, last week, we had a Federal Reserve meeting where the Fed, as expected, chose to keep rates steady at a range of 4.25 to 4.5% here, continuing a pause since December of 2024. Very much a wait and see environment. As you can see, rates have been unchanged for just about 8 to 9 months now. Two Federal Reserve governors dissented in favor of a 25 basis point cut, the first double dissent since 1993. So, a lot of growing divisions within the Federal Reserve as the economic outlook continues to be very uncertain. Still a lot of uncertainty for the September meeting, but with that weaker jobs report in July, depending on the upcoming data over the next 2 months, we may see the first rate cut since 2024 at the September meeting. So we'll have to keep an eye on the incoming labor market, inflation, and other economic data in the meantime to get some more guidance on what the Fed might do at their next meeting. Unlike the jobs report, second quarter GDP growth came in stronger than expected, with real GDP rising at an annualized rate of 3%. The upside surprise was largely driven by a sharp decline in imports, which are a subtraction from GDP, so that was a positive contributor by about 5% to the GDP print, as well as steady consumer spending growth, about flat government spending, and then a slight reduction in exports were a negative contributor to the GDP print. And then last but not least, business investment dropped about 3% in the quarter. So that is something we do want to keep an eye on, as that is a economic indicator. When investment increases, that means there is higher confidence in the economy. When it decreases, it means lower confidence in the US economy. So overall, better than expected, but very nuanced. Last week's PCE inflation data echoed the earlier June CPI print, reinforcing signs that inflation might be picking up. We had headline inflation rise 2.6% from a year ago, while core PCE was up 2.8% from June of 2024. Both measures were up 0.3% month over month. It is too early to call a trend in this rise in inflation, but it does raise questions about whether or not this is a temporary blip or the early impact of increased tariff-related costs working their way through the economy. Alongside the PCE inflation report, June data showed the personal income, spending, and savings data for the month of June as well. Both increased 0.3% in the month, which led the personal savings rate to be flat at 4.5% in June here. Overall, this was not a extremely bullish or bearish reading, just pretty steady as income increased with spending. Lastly, U.S. consumer confidence edged higher in July, continuing its recovery since the sharp decrease in April, still remaining below year-ago levels. The expectations index improved across all components, with consumers feeling less pessimistic about future business conditions and employment and more optimistic about income prospects. However, perceptions of current job availability weakened for the seventh consecutive month, reaching the lowest level since March of 2021, echoing the softness that we saw in the July jobs report. So, overall, still got an improvement in consumer confidence, but pretty minor when you look at the overall downtrend. That concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again soon.
The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.